it's your boy GTS, and this is the fourth episode in Mastering the Mindset series. And what we're actually going to do is something a little bit different. We've talked about patience, greed, and fear. And essentially, these three emotions are the three most important emotions that will play a role when it comes to investing money and trading, right? In the financial markets, when money is on the line, these emotions tend to creep up. And it's about controlling these emotions, not trying to get rid of them completely, because that's not going to happen unless you're a robot, but instead it's trying to understand them, control them, and basically learn to temper them along your trading journey, right? But with that being said, episode number 4, what I want to do is I want to try and give you guys practical advice, right? Real advice that you guys can use to help you along your trading journey that incorporates all of these things, the patience, the greed, and the fear. Because, look, at the end of the day, I can talk about these emotions, but what's a practical way to actually implement methods, processes in order to control the emotions, right? That is what you want, because I can tell you don't be fearful. What does that even mean? Like, don't be fearful. Somehow that's just going to click. I'm going to hypnotize you and suddenly you won't be fearful. That's not going to work. So with that being said, we're going to give you practical, real life things that you can use in your trading journey and even investing in the markets. As many of you know, I've been in the financial markets for over 15 years. Equities, options, commodities, Forex, you name it, right? So let's dive straight in. And the first thing, one of the most important things I think, well, not that I think, I know, is planning, right? If you fail to plan, you plan to fail. What does that mean? Well, in realistic terms, it means really planning out what you intend to trade, right? You're not being reactive, right? So what that means is, let's say you're looking at a currency pair or a stock, anything at all, right? You want to trade for the coming week. You want to look at news events that might affect it. What is the primary trend? Could we be due for a pullback? Now, you don't want to overload of information, but at the same time, kind of looking at where the price action of that asset is, how it's reacting, what it's been doing in the short term versus the medium to long term, right? Understanding perhaps what the news event coming up in the week might have in terms of impact, or the impact it had on a previous similar news event, right? Will help you to mentally prepare. Now, that doesn't mean that you go in with a sort of fixed plan of this is exactly what's going to happen. Why? Because we're trying to predict the future. Therefore, you must be dynamic in your approach. If something that you thought was going to happen doesn't happen, then you need to switch up and be willing to not be too fixated on a certain outcome, right? So always planning. What I like to do, specifically for trading gold, every Sunday, I'll look at the weekly chart. Where are we there? And then I'll have multiple charts open. I'll look at the daily. Is there a possibility of a pullback, or are we at the end of a pullback? Have we been ranging? Are we at the bottom of the top of a range? So then I can look for clues in a smaller time frame. Are we going to break out that range? So when it comes to it, I've maybe already thought of these scenarios and I'm ready for them, right? I'm ready if price action goes not the way I intended. So, like I said, if you fail to plan, you plan to fail. And hand in hand with that comes a trading journal. So many traders neglect this, right? And a trading journal is actually the same if you're even trading stocks or buying stocks. You want to journal why you bought a stock, the reasons for getting into it, what things are bullish about it, or what makes you confident about its future. The same with trading a pair or looking at gold. You want to journal every move you make, why you made it, was it a success, was there emotions there that you had to keep in check? Because by writing down these things, by putting pen to paper, what that does is it helps to learn these lessons in your mind. It solidifies them, right? We tend to make the same mistakes over and over. Why do we do them? Because the reason we do them is because we don't really think about our mistakes. And it's an innate evolutionary behavior, right? We forget about the bad things quickly so we can move forward, right? We don't dwell on the bad. And that doesn't work for trading. For trading, you don't necessarily want to dwell on the bad, but you want to learn from it. And the best way to learn about something is to actually think about it, analyze what you've done, put pen to paper, and it's more likely to stick in your mind so that the lesson is learned for the next time. So a journal is just as important as it is to plan for things. And guess what? Tying this back to emotions, it's going to help you to curb fear. It's going to help you to be patient. It's going to help you to not be greedy. Why? Because if you've looked at the week ahead and you've thought about the way an asset could move, when it doesn't move a certain way, you're ready for it to move another way. You're not reacting. You're active to the movements. Do you see what I'm saying? So this is very important. So that's number one, right? Number two has got to be confirmation bias. We all want to be right. We all want to be right. We all want that, I was right, I got it. But the market does not care if you're wrong or right. The market's going to do what the market's going to do. This is where confirmation biases, right? We're always looking for things to confirm our biases. Oh, the weekly trend's up for 3 weeks in a row. It must go up. Oh, the daily's showing up. That might be true, and you're putting probability on your side, which is what you should do. But you need to be open to the possibility of that could change. It could turn, right? Or it could be like, I see the 5-minute candle doing a certain movement, and therefore I'm right, and this is going to happen. No, confirmation bias is going to present you with other emotions, right? It's going to make you angry when it doesn't go the way you thought because you had a confirmation bias. That anger is going to lead to greed, impatience. Do you see what I'm saying? Now, once you have greed and impatience, you're going to make bad moves. And when you make bad moves, it will feed into the fear. What did I say in the previous episode? That all these emotions are linked somewhat, right? They all have a cascading effect. They all intermingle. And that is very much true, especially when you're looking for things to happen because you believe the market should react the way you think. That's not going to happen. The market does not care about you. Confirmation bias out the window. And more so, you should be looking at, and we're going to segue into the third point. You're going to be looking at, price pays. And so the way to get rid of confirmation bias is to look at price pays. And I spoke about this in my very first YouTube video. And what is price pays? Well, it's almost the folly of forecasting, right? Let me put it to you this way. So we essentially as traders do not care or give too much weight to why something happens, right? At the end of the day, we just look at price action because if we are to look at, say, a news event and we're thinking, if a figure for this news event comes in at this, therefore this will happen. One, you've got a confirmation bias and you're using news to think that you know how the market will react to news. That's not the way it works because the market will react the way it wants to react. Sometimes it will react to what may seem counterintuitive. The reason I use quote marks for counterintuitive is because just because you think something's intuitive doesn't mean that it is. Because again, the market doesn't care, right? The market's going to do what it's going to do. Therefore, price pays. And what do I mean by price pays? We look at price action and we trade what is in front of us, not what we think. Right? This is very important. We trade what is in front of us. So you're constantly using a dynamic approach to look at how price action is evolving before your very eyes. And then you're adding that information to the left-hand side of the chart to make a prediction about the future. And therefore, your best indicator is not what you think or not what your reaction to the news or if the news is good or bad, but it's actual fact, what is price action telling you? Right? And that is going to be your best tool. Not any indicator, not any confirmation, not any biases, none of that stuff, right? Price pays. Don't try and forecast when you're trying to trade movements of assets, particularly in Forex, right? It's different for stock investing. When you're investing in equities for the long term, you need to look at information. The market might misperceive a piece of information, and there you have got there's a gap in the value, the perceived value, where you can jump in on and you can profit from that, right? If the market sees something, it perceives it as being bad in the short term because it's not looking at it in a long-term lens. For equity investing, that's great. But when it comes specifically to trading, right, You just want to trade what's in front of you. It doesn't matter if the market thinks the news is bad, but it was good. That goes out the window, okay? So this is practical ways that you can actually harness your emotions, use your emotions, learn to curb them. And what I would suggest is watch episode 1, 2, and 3 again, and then come back to this, and it will make even more sense, right? So, if you fail to plan, you plan to fail. Be ready to plan for everything for the week ahead, but also be ready to be dynamic, right, in your approach. Don't be reactive. Have a journal. Note down everything. That way you learn lessons, right? And your chance of repeating those mistakes will definitely go down, right? Second thing is don't look for confirmation biases. Why? Because the market doesn't care what you think, right? Not at all. So don't look for biases. Now, that's not to say you don't have certain expectations, because you are trying to predict the future at the end of the day. But if they're wrong, you don't hold on to it, right? And that will stop you having like sunk cost fallacies, will stop you getting emotional, angry. Anger will lead to impatience and greed, and then fear, right? And the third thing is don't try and forecast too much. Price pays. We're trying to catch movements in trading, right? That's all. We don't care if we're wrong or right. We're just trying to catch movements, and therefore, price pays. But that is me out for the now. Let's go GTS.